All right, let's talk politics a little bit. Politics on the market. You might think, sort of conventional wisdom, right, that the Republican candidate would be better for the stock market. Mark Hulbert tells us that might not be the case. Let's take the contrarian argument on this one, Mark.
Yeah, I wrote a column based on the views in this regard of Norman Fosbeck. He's a guy who's been around for decades. He used to run something called the Institute for Econometric Research, had a number of different advisory services, and he often takes an unconventional view of these things. It was something that I had to hold my breath in doing because I got a huge number of negative comments of why I would even write about this in the first place. People think that that you can't even talk about this without being partisan. All he's trying to do, if I read him correctly, is say, hey guys, let's just take a look at that assumption. And it turns out that his argument is that even if you believe, and there are people who disagree on this, but even if you believe that the Republican agenda will be good for the economy long term, there's a lot of pain that you're going to have to go through first. And indeed, you almost risk going into a Japan-like deflation for a long, long time if anything goes wrong in the process. So the stock market only looks out several years if indeed it starts looking at the probability of something like that. It could go down a long ways first, even if it eventually starts discounting a much better future.
And I mean, let's break down some of the things he says. He talks about taxes, right? I mean, obviously Romney talks about lowering taxes. Mixed bag there, though. It's not such an easy deal.
Well, that's right. He says that of the three things: cut spending, cut taxes, and get rid of Ben Bernanke at the Fed. Sort of the three pillars of the agenda. The one that is the most positive for stocks is cutting taxes, because that'll increase the after-tax return for stocks. But as you point out, it turns out that you can over-exaggerate that because it's only lowering the statutory rate. If you look at the statutory rate on corporate taxes, for example, hardly any corporations pay anywhere close to that right now. And so it may not have the impact that on paper it superficially looks like it might have.
Right. And I mean, Ben Bernanke, I can't imagine you could get a central banker who would actually be hard on the banks. So I don't know what getting rid of Ben Bernanke is really going to do.
Well, that's right. Basically, Norm Fosbeck's comment is that you need to tread carefully on this. It's a big gamble. Let's say that you make one mistake and you're going through this three-point agenda, and there is another financial crisis, and there is a real worry that there's a meltdown. Are you willing to create sort of a financial Armageddon in the process of trying to wean the patient off of the addiction to death, which
right.
is what many people would say is our economy's affliction right now. But, you can perhaps kill the patient in the process of getting him off his addiction, and that's his worry.
Yeah. All right. We have to leave it there, Mark. Thank you very much. And obviously, the real contrarian thing is he also doesn't say that an Obama election would be so great for the stock market either, but that's for another column. Mark, thank you very much.